It's a dangerous thing because dollar cost averaging is based on price, not fundamentals. It really helps Wall Street because what they can do is talk you into no matter what, buy our stuff. In other words, dollar cost averaging says, don't just buy it when it's on sale, but buy it when it's really expensive and buy it in the middle. And just the dollar cost averaging has one thing, buy all the time. Well, if you're a Wall Street firm and you make money on assets under management, that's a great win for Wall Street. So I'm not so sure I'm a fan of dollar cost averaging. I'm more of a fan of saying, look, fundamentally, what do I think this company's worth based when I look at its earnings, its growth, its EBITDA, its, what is its enterprise value as opposed to EBITDA, right? How does it operate? Then I kind of come up with my own price, saying this is what I'd be willing to pay. I think this is a bargain. And I think based on the cash flow I can create out of it with dividend and writing options on it, I could pay for itself in X amount of years. And I can be wrong on that. Sometimes it might take longer. But it's just like Bitcoin, if they're horrible options, they're not liquid, the spreads are nasty. You wouldn't want to trade more than 1 or 2 Bitcoins in that environment yet. It'll get to where it'll be bigger as options markets grow. They always do. But I will tell you, regardless of all that crap associated with it, I still feel confident that my Bitcoin will pay for itself. And I'll have the asset with none of my own money in it. And at that point, you get infinite returns. So it's about a business, not a stock, or an asset, not a price. It's about cash flow, getting the cash flow. And then third, it's about positioning. Because when people hear bear market, don't you think they feel tragic, negative, awful?
Absolutely.
It's positioning. Look, if you go to the gas pump and you are a single parent going to their job and you're on a fixed income and all of a sudden the price of gas doubles, okay, that's bad news for you because you didn't get a raise at the same rate and you now have less money to do fun stuff with. You have to pay more for gas. Now you have to cut piano lessons maybe or something, right? That's bad news. So their inflation is bad news. Okay, now, what if you pull up the gas pump, like one of the stocks I own is ExxonMobil. They've paid a dividend since I was in high school, and they've kept it the same and increased it every year for 36 years. Okay, that's like a stock that I like. So if I go and I own ExxonMobil and I see the gas pump going up, I'm going to get excited about a dividend and look at the price of oil and Exxon and price. So inflation is good or bad news depending on what side of the coin you're on. And so, my third pillar, cash flow, fundamentals, technicals for the information. The third pillar, cash flow, is about positioning yourself in the bear market or the bull market to benefit from what you've learned about fundamentals and technicals. And then the last pillar is your risk management. You got to keep an eye on it. Look, investing is not risk-free. It's not easy to do. I do my very best to repel the get-rich-quick student because they're not fun to teach, Greg. They're not. They have expectations that are stupid and unrealistic. So we work very hard to repel the crazy guy and get the person. I get it. Compounding's real. Okay, I can compound. That math works for everyone. I'm not blind to the risk that I'm going to have some days or years where I'm down in the market, but I'm ready to go and I'm ready to learn. That's the student we attract, is that temperament. Not afraid of a bear market, excited to think there's opportunity. It's on sale. I mean, it's Black Friday, right? It's Black Swan, Black Friday. There you go.
Okay.